Hey guys, my name is Max Convexity. Thanks for tuning into my station. Today I'm going to look at ULTY and SLTY. Now, is it like peanut butter and chocolate, like a Reese's Pieces, great combo? Or is it like Taylor and Travis, great combo? Or is it like Kim and Kanye, not so great? Stick around, we'll get right in the middle of it. ULTY and SLTY, hedger's paradise or hell on earth? Well, let's take a look. So, ULMAX's SLTY ETF launches this Thursday, according to Twitter, according to ULMAX's own feed. Now, SLTY is going to be a short version of the highly popular fund ULTY, and there's a lot of interest in ULTY. Obviously, it's been doing great, and it's has a ton of assets under management, and a lot of people like it. Well, SLTY is just going to kind of be the inverse of that. So let's break down what this actually looks like together, using them together, and kind of how to think about that. So SLTY is designed in a very similar manner to ULTY, but will not necessarily include the same stocks, but it's going to include stocks that have high IV that they do not like, that they have a bearish outlook on, whereas ULTY uses stocks with a high IV that they have a bullish outlook on. And like I said, ULTY has like more than $3 billion under management. It's just been a behemoth. So SLTY or short ULTY, SLTY, some people are calling it other names, but SLTY is designed to find high IV stocks and sell option premium, just like ULTY. SLTY will use a variety of option strategies. Looking at the prospectus, they can use many things, but I would imagine they usually sell covered puts. Now, a covered put is where you short stock and you combine it with selling an out of the money put. So it's the inverse of a covered call, basically. It's a covered call with short stock instead of long stock. All right. Now, SLTY's path dependency, what SLTY wants is lower prices, but not too much lower. Just like ULTY, it's going to be totally capped out. So in a big down move, there's going to be opportunity cost. Now, ULTY wants a gently uptrending market. ULTY wants the market to go up, but not too much, not over their strikes of the individual stocks. So SLTY is kind of the opposite. They want a gently downsloping path. Now, a lot of folks are planning on hedging ULTY with SLTY. This could definitely provide some benefits. However, hedges cost money. Everything costs money. You've heard me say before, there's no free money a time or two. Well, still holds true today. Let's take a realistic but honest look at using this pair. All right, so one thing about using a pairs trade like this, ULTY and SLTY, you could smooth out the volatility from ULTY's positions. And also both of them, I would imagine, are going to include a mix of income and return of capital. So the pill's obvious to me, but many of my friends, my good friend Ambassador Kwan from Twitter and my friend Tom from my Discord, disagree with me, and that's fine with me. I encourage diversity of opinions. I say, why not hedge your ULTY position with something that should zig when ULTY zags, but there's not universal agreement on that. And I'm going to give you another couple of ideas if you don't want to do that, to stick around to the end. All right, so the 50-50 strategy, you hear a lot of newbies talking about this. And when Tesla and Crash came out, people were talking just buy 50% of each and, live a happy life. Well, it's a little bit more to it than that. If you went 50-50 on ULTY and SLTY, you're essentially building a synthetic iron condor position. For those familiar with options, you understand iron condors are designed to profit in a range-bound market, and they work beautifully when the underlying stays within your expected range, generate steady income from both sides. The catch is a big move in either direction costs you profit on one of the legs, and the other leg won't make enough to offset it, so it creates a loss. Big moves in either direction. So can you hedge ULTY today? And you can. I've been hedging ULTY for 6 months, I think pretty darn effectively. You can use YQQQ from YieldMax. Now, this does the same option strategy that I believe SLTY is going to do, the short stock plus synthetic puts, or not synthetic puts, short stock plus an out of the money short put. I'm obsessed with synthetics. I need to quit saying that so much. I love ULTY. But during market corrections, it's going to get hurt. YQQQ benefits from market downturns. And as such, I think it's worked out pretty decently as a hedge, notwithstanding what Ambassador and Tom say. I'm just saying my opinion, it's worked out pretty nice. And I think YQQQ is going to be a good proxy for SLTY. It's the only thing we have to look at also. I like data-driven results, but we can look at some data on YQQQ and use that kind of as a proxy for what a hedge with SLTY might look like. As soon as SLTY comes out and has data, we're going to start running all kinds of numbers on SLTY itself. But for now, let's talk about the YQQQ ULTY hedge. Okay, in March and April of this year, ULTY's NAV dropped 14.6%, and that's total return, including dividends. ULTY's share price dropped from $7.38 to $5.42. What is that? To $1.96, $1.96 on 738. That's like 25%. It's a big drop. They shed 25% in NAV. And that's just because the market went down. Luckily, they only lost 14.6% when you include the dividends, because that's the way option premium works. It gives you a little bit of buffer, but neither number was fun. It's not fun losing 14.6. It's not fun losing 25%. Now, YQQQ during the same exact time frame was up 11.97% on a total return basis, and its shares were up $1.49 over the same exact time frame. The YQQQ shares went from 1726 to 1875. Okay, so remember, in a sideways market, both of these ETFs will generate their distribution. And mild volatility, a market that goes up and down but not too big, SLTY will provide offset to some of ULTY swings in the same way that YQQQ has. Range-bound action, you're going to collect income from both strategies. But during significant market moves, crashes or melt-ups, both positions, whether it be SLTY and ULTY, whether it be ULTY and YQQQ, both positions will face pressure simultaneously. The option mechanics that generate income for both funds get stressed when volatility expands and or the market gaps outside of expected range, or more specifically, gaps over the short strike. Here's the mathematical reality. Markets trend up roughly 70% of the time. 50-50 allocation, whether we're talking ULTY and SLTY or whether we're talking ULTY and YQQQ, you're giving up a lot of the market. You're giving up, you're leaving too much on the table. Let's just say it that way. In my opinion, people say covered call ETFs don't get any upside. Well, it's true. They don't get a lot of upside. They don't get as much as the parent. They do get some upside. And if you're cutting off all the upside with that 50-50 allocation, you're a good part of the upside with that 50-50 allocation. You're hurting yourself in the long run. Remember, total returns, what causes your account to compound. We want the highest total return possible. So you're essentially paying an opportunity cost for smoother returns. And that may be what you want or may not. But I'm going to suggest another strategy other than 50-50. If you want to use both products, the math suggests favoring ULTY heavily, something like 80-20, maybe 85-15. This maintains you still have meaningful upside exposure with either 80% or 85% of the bullish asset. You'll get some volatility dampening, whether it be from SLTY or YQQQ. I think it's more accurate to think of SLTY or YQQQ for that matter as a volatility reducer rather than a true hedge. So let's run a few tests. I got in Portfolio Visualizer and I looked at since inception with YQQQ, and I'm using the YQQQ for the proxy for SLTY. So this very top result up here, this is 100%. This is 100,000 in YQQQ. I'm sorry, in ULTY since inception, no YQQQ. So unlevered or unhedged, I should say. Well, your 100,000 over the past year, this isn't even a year. This is not 11 months. Turned into more than 125,000. It's up about 27%. Okay. The third line down here is just the SPY. The SPY's up 17% in the same time, which is good. It's been a good market. SPY is doing fine. This middle line right here is 85-15 allocation. And so on the middle line, you didn't have quite as much return as ALTY by itself, but you did beat the benchmark. And also, if you notice, the dark blue line here is ALTY by itself. Of course, that one, the unhedged position, was down the most. You can see with any of the other positions, you had smoother results. Now, this bottom line down here is a 50-50 allocation, or it's a 50-50 allocation. I wanted to show kind of what overhedging will do. Overhedging gives you really smooth results. You didn't lose that much. It looks like you were only down about 6% at the worst, but the problem is you're only up about 4 or 5% after a year. You left money on the table compared to using any of the other strategies, let's just say. So these are the raw numbers from my study. 100% ALTY gets you a 27.3% total return, but causes a 17.8% max drawdown. That's the most bullish scenario. And then I have all the other scenarios underneath that. Now, luckily, I made a handy infographic that shows this stuff more clear, and I encourage you guys to go check it out. I'm going to put the link to it. But let's just say right now we check it out ourselves. Okay, so this is the ALTY YQQQ strategy. And this is based on real results over the past 11 months. And this is according to Portfolio Visualizer. So I wanted to use some benchmarks just to put kind of the benchmark for ALTY. And that's not a bad benchmark. The Qs over this same time period were up 19.3% and had a 10.1% drawdown. That's really good. The Qs did really well. I really think that maybe the triple leverage Qs might be a better underline to look at for ALTY, because ALTY uses high beta stocks. So the triple leverage Qs were up 30% over the same time frame, but the drawdown was 33%. So I really think maybe the double leverage Qs. I just don't know if there is a double leverage Qs. The double leverage Qs might be the best, most fair benchmark. But in any event, ALTY's benchmark is somewhere between these two numbers. And I think that's fair, because look how ALTY did over the test period. ALTY had 27.3% return. We've already seen that. That's really good. And ALTY had a 17.8% drawdown. It's more than the Qs as the benchmark, but it's less than the triple Qs. Like I say, they're true benchmarks somewhere in between here. I think the ultimate range is 80 to 85%. And we're going to talk about what the hedges cost. We want to look at all this. We want to look at the efficient frontier. Over here is 100% ALTY, and you can see you have the most total return, but also you have the highest drawdown. And as you use lower portions of ALTY, you can vary your math. I think where the green is the sweet spot, but that's for you to decide. I would encourage you to go look at this yourself. The 50-50 trap, just to kind of reiterate, because I see a bunch of people talking about that. So the 50-50 trap, you only got 6.3% returns, and you gave up a lot. We're going to look at that here in a second, but you only got 6.3% returns, and the hedging cost almost 10% there. Let's look at this another way. I think this is a better way to look at it. So here's your upside, 27.3. But here's your downside, 17.8. That's on 100% ALTY. Not that there's anything wrong with that, but that's just kind of where we start. So here's 90-10. On 90-10, you only have 23% total return instead of 27%. But you had a max drawdown of 15%. You improved your max drawdown a little bit. On 85, which I think is optimum, you had a 21% total return, but you improved your max drawdown a little bit. Okay, now, so if only there was a number where we could calculate what we're really giving up, and you'll be happy to hear I came up with one. Here's the true cost of hedging. Okay, so here's the 100% right here. It has no cost. I mean, it's because you aren't giving up anything. That's the base case. That's what we're basing it on. Okay, here's 90-10. On the 90-10, your total return goes from 27.3 to 23.3. Okay. So you missed 14.6% of the upside. Yeah, that was your cost. However, here's your benefit. You improved your drawdown by 13.48%. It's still a net negative. The net hedging cost on 90/10 was 1.17%. That's what the hedge cost. Okay, here it is in black and white. The 100%, that's our base case. On the 90%, you went from total return of 20 to a total return of 25. That means you missed 14.6% of the upside. Well, that's all right because you improved your drawdown by 13.48%. Instead of losing 17, you're only exposed yourself to 15. So we can roll this forward on all the other ones. On the 85/15, your total return went from 27 to 21, meaning you missed 23% of the upside. Well, you saved yourself 20% as far as the drawdown improvement. Your drawdown improved by 20%. Still a net cost, of course. You cost yourself 2.85% over being unhedged. On the 80/20, you cost yourself 2.7%. The 80/20 works out best on math. You improved your total return went down by 29.5%, but your drawdown also went down by 26%, just call it. So that's a 2.7% opportunity loss. And that's our winner just mathematically. But then you can go down here, you can see here as you hedge more, there's more of a cost. And we would expect that because there's a cost to hedging. And you can even get down here where you overhedge like 50/50 or 40/60, and you're really costing yourself, a lot of total return without getting the requisite benefit. Now, if you can look at that same chart right here, 90% you cost yourself opportunity cost of 14.65, but you improved your drawdown by 13.48. The difference is the true cost, 1.17. Just graphically, I'm a kind of a graphical person. I'm fine with the opportunity cost before it just falls off the map. I think anything under 70 is just, it's really becoming expensive. And then of course, if you overhedge, it's super expensive. All right. So based on YieldMax's products, like I say, we don't have SLTY yet. The second the prospectus hits the internet, the real prospectus, and I imagine that might be tonight or tomorrow night, I'll do an in-depth review of exactly what's in the prospectus, but just based on what we know about YieldMax products. Distributions often include a significant return of capital, but the other side is that can offer tax benefits. You don't own the underlying assets directly sometimes, and I think that's 100% fine, but it's something to understand. In the case of ULTY and SLTY, you actually will own the assets directly in most cases, I believe. But either way, I don't really think that's a big deal. But the option strategies are sophisticated, of course. They can be volatile themselves. And of course, the performance is going to vary based on market conditions and volatility. So let's talk about some different ways to use this pair. The bullish but cautious, and I've used all three of these approaches, and I'm going to probably do something similar with ULTY and SLTY. Bullish but cautious would be 85/15. You still get most of the upside, and that's bullish but cautious. A moderate approach would be 80/20, and that's a really balanced approach. And just mathematically on what we give up, that one actually came out the best. Now, then there's the Chicken Little approach. That's the 70/30, and I've used this approach myself. In March and April of this year, I used exactly this approach, and I was darn glad I did. After Trump changed his mind on the tariffs, I believe that was April 9th, I went back from 70/30 to bullish but cautious, and that's where I sit now, approximately 85/15. And I'm actually about 87/13 or something. I actually have even a little bit less YQQQ, but it's because it's been a great time for risk assets, and I want to be bullish, still have a little bit of caution. All right, so the bottom line, SLTY and ULTY, just like SLTY and YQQQ, it can work as a strategy, as a tactic. It's important to understand you're building something that kind of resembles an iron condor, great in range-bound markets and not so great in other markets. The key is going to be sizing appropriately based on what you're actually trying to achieve. Based on YQQQ and ULTY, the number was 80/20, but 85/15 could work also. It depends on what you expect. But I would definitely recommend leaning towards the bullish one. But if you prioritize smoother returns and still steady distributions, you can increase the SLTY allocation a little bit. Remember, there's no free lunch. Every hedge has a cost. We looked at the cost of every hedge here. The cost is typically measured in upside that you've missed. What are your thoughts on the optimal allocations? Are you like my friend Tom and my friend Ambassador, and you don't want to hedge? That's fine too. I'm just curious to see how this is going to play out over different market cycles. And remember, you do not have to hedge. No one, certainly not me, said you must hedge. Here's one way to do it: just spend less. If you're nervous but you don't want to hedge, instead of if you were going to buy $10,000 worth of YQQQ, buy $8,000, maybe buy 80% or buy 70%, and your cash is the hedge. If the market pulls back, maybe you could average down. Or if the market pulls back, you'll be darn glad you didn't put 100% of what you were going to put in there. You'll be glad you only had 80 or 70. That's a very legitimate way to also make a tactical type hedge. You could also hedge this yourself with Q put options. You could look for other ETFs like Dorsey Wright Short. DWSH is a pretty good looking ETF that does the same thing YLTY is going to do. It tries to find stocks that it doesn't like. Now, DWSH does not sell premium, but they are a short fund where they try to short stocks that they don't feel have good prospects going forward. Then you could also use something like Chaos. That's a good fund. And something like TEL. I'm not crazy about TEL, but those also could work. And there's other things that could work. Remember, you do you. This is not financial advice. You don't have to hedge. You don't have to hedge. I hope you found some idea in here that might help you. But definitely not financial advice on this kind of stuff. All right, guys, from Hill Country with Love, Max out.